Welcome back to the Daily Stack. Today, it's August 9th, 2025. This is not financial advice, unless your trading plan is ape because the meme is dank. Then carry on at your own risk. We're stacking with purpose here. Let's dive in. The market just woke up. If you've been watching crypto this week, it's been like staring at a raccoon in your backyard. Quiet, twitchy, maybe a little cute, but you just know it's about to flip your garbage cans and run off with your leftovers. Well, today, the raccoon broke into the fridge. ETF inflows just kicked the back door in. Meme coins are throwing parties, and policy shifts are coming in hot enough to roast marshmallows over. If you were bored earlier this week, wake up. We've got moves to make.
Keep scatching. Stacking coins like bricks on bricks. Watch the market flip, quick tricks, slick picks, dodging rug pulls like a ninja, no sweat. Blockchain jungle where the lions get fed. Gas fees high! Gas fees high, but my hustle runs deeper. Hate your deal tight, wallet heavy like a sleeper. Crypto fever, can't cool this fire. Charts looking dizzy, but my aim's still higher.
Crypto's got its swagger back. Bitcoin just reclaimed the $117,000 zone like it owns the block, bouncing hard and after 4 straight days of ETF outflows. That had everyone wondering if the party was over. Spoiler, it's not. The inflow switch flipped fast. 91.5 million charged into Bitcoin spot ETFs. Blackrock's iBit led the stampede with 156 million. Larry Fink probably ordered champagne for lunch. Fidelity's FBTC pulled in 43 million. Grayscale's locked in 14.5. VanEck HODL ETF tossed 4 million in for good measure. This isn't retail panic buying at 3 a.m. That's what real conviction looks like. And if it wasn't just Bitcoin's story, Thursday saw 503 million in ETF inflows across Bitcoin and ETH combined. Capital flowing like it just remembered what bull markets are for. Today, total crypto market cap popped over 3%, nudging past 3.9 trillion. XRP flexed with near 13% run, Dogecoin barked back with 6.4%, and even the miners caught a little relief. Bitcoin difficulty eased by about 3%, meaning hashers got a break from the mining treadmill from hell. But here's the thing, these aren't runaway pumps. This is reaccumulation. Institutions aren't looking for quick dopamine hits. They're building positions with retail still side-eyeing the charts. If you've been waiting for a clear signal, this might be it. Meme coins are doing what meme coins do, causing chaos, generating dopamine, and occasionally making a few other people way richer than they probably ever should have been. Pepe volume popped 25%, Doge reclaimed old ground with 6% gain, Pengu waddled into the spotlight. These aren't just random pumps, these are liquidity events with whales lurking underneath. On-chain sleuths clocking big wallets stacking Lil Pepe and SPX 6900 like they're buying beachfront real estate in 1970. This isn't just degeneracy, it's narrative positioning. Meme coins in this phase of the cycle aren't just inside jokes, they're cultural option contracts. If the meme catches fire, so does your bag. But here's the cautionary tale. Meme season is the market's version of tequila shots. A couple and you're laughing. Too many and you're waking up without your wallet. Play it for fun, but keep a sober head. Look for accumulation patterns, well behavior, and community traction, not just green candles. This week's regulatory shift was way less quiet memo and more shockwave. The 401k crypto executive order just landed, and while it's not fully baked in yet, the potential runway is enormous. Up to 9 trillion in retirement capital would eventually flow into digital assets. Yes, trillion, with a T. The reality check, these aren't all hitting tomorrow. Retirement plans move like glaciers, slow but unstoppable once they get going. The bigger takeaway is that this is a directional change. Policymakers are opening the gates. The infrastructure is not ready yet, but when it is, the pipes will already be laid. Meanwhile, Ripple officially slammed the books shut on the SEC drama. The lawsuit's gone. XRP immediately popped 11% like it just shed a 10-ton backpack. Whether you're an XRP maxi or just someone who loves seeing the SEC lose around, this is a big moment for regulatory clarity. This is the slow burn-off that turns crypto into finance. Every time big policy shift lands, it becomes harder for legacy finance to treat digital assets as an experiment. This is the long game. While headlines shout, the blockchain whispers, and right now, the whispers are bullish. ETH on-chain activity is flexing hard. 1.74 million daily transactions, smashing prior cycle highs. This isn't just NFT mint weekend, it's DeFi flows, staking operations, and everyday users actually using the chain. Utility is the biggest vote of confidence you can get, and ETH is stacking votes like it's running for office. Bitcoin realized price is holding firm at 106,000. Meanwhile, the average holder's cost basis is nowhere near panic modes. This suggests conviction holding, not weak hands. Future markets are stable too. Funding rates aren't spiking. The open interest is flat. That means no one over leveraging the board right now. This is strategic capital deployment, not casino night. On-chain data isn't screaming top or bottom. It's saying, we're building. And if you've been around, you know that's when the best positions get built. Forget the tip of the day. This is one you keep in your back pocket forever. If you're serious about growing a crypto portfolio, you need to start thinking like a builder, not a gambler. And that means few eternal truths. 1, follow the money, not the memes. Memes can be a part of your strategy, but the real alpha coins come from tracking ETF flows, institutional buys, and on-chain activity. If you know where the whales are swimming, you can ride the current instead of guessing where the next wave is. 2, utility beats hype every time. Projects that keep showing up day after day, year after year, eventually outpace whatever's trending on Twitter. Ethereum, Bitcoin, even certain layer 2s. They win because people actually need and use them. 3, regulation moves markets. Slowly, then suddenly. When policy shifts, the impact takes time to ripple through. Don't get impatient. Position yourself for where the ball is going, not where it is now. 4, treat memes as culture plays. If you buy memes, do it with a thesis. Who's behind it? What's the community like? Are whales holding? Are they expanding onto multiple chains? If it's just noise, you're the exit liquidity. 5, let the chain be your guide. Price action can fake you out. On-chain metrics rarely lie. Watch active addresses, liquidity pools, token holder growth, and staking inflows. If usage is rising, the charts usually follow. 6, keep dry powder stash. The market will always give you another shot. If you're all in at the time, you're playing with a safety net made of tissue paper. Keep something on the sidelines for when fear is completely maxed out. 7, play your own game. Not every trade needs to be timed to perfection. Know your time horizon, know the risk tolerance, and stick to your system. The loudest voices on social media will never take the loss for you. If you follow that playbook, you won't need hot tips. You'll have a strategy that survives bull runs, bear markets, and everything in between. Only ever click the official hardware link in the episode description. Skip Discord promos, Twitter DMs, or meme giveaway hypes. Your keys remain sacred. Stack smart, stack daily, and I'll see you degens tomorrow.
Running the chain like a king on a throne. Digits on digits, this world is my own. Ruling the blockchain, no cap, no clone. Crypto's my empire, I'm bad to the bone.